Hey there, it's Les Sulgrove. This is Sunday, June 8th, 2025. It is the 23rd week of the year. Welcome to the show. I'm really excited about this week's show. I always love it when I get back from NAR mid-year meetings or legislative meetings, as they're called now, and be able to bring you back the national real estate stats and compare them to kind of what's going on in the Des Moines and Central Iowa market. And this year is no different. Dr. Lawrence Yun was in top form this year, and as you will see, I had prime seating. So let's jump right into the show. Let's get this one started. So here's the question. Last week I asked a question that, or I basically made a statement that the market appears to be softening a little bit. And this was confirmed in Washington, D.C. this past week when we sat and talked or listened to Dr. Lawrence Yun. Essentially, what his message was is that national housing recovery is a bit delayed. And I am basically going to compare that to Iowa and see kind of where we're at this year. So, the rumors are true. It sounds like the market is just not performing quite as well as we hoped it would as we moved into the new year and into the new spring and summer markets here. But don't worry, we're still got some good predictions, and I think we've got a good message to deliver that we're going to be out of this sooner than later. So let's start off here first of all, as we always do, with the weekly dashboard. Week 23, our inventory is up plus 20%. But one thing we've seen again this week, second week in a row, we've seen the number of sale pendings behind last year's numbers. They're still fairly strong for a spring market, but they were not at the same pace as the same week last year. Closed sales are a little bit behind, but just maybe in this particular case, we saw the week ended or the end of the month ended just after the last weekend, and so we were a little bit behind on closed sales as we started last week's show, but we're only about 87 homes ahead this year after the week went past and we got all those end of May closings recorded here. So we're up 87, so that's back up a little bit. Last week it was lower and we were getting a little bit concerned, but that's why I say we don't always want to make our calls on whether something's going bad or going good based on one week's data there. So mortgage interest rates, we'll talk about that today a little bit. They're currently at 6.85%, and it's down just a little bit from last week, but we're still up where we would like to be out of. We would like to be a little bit lower, and Dr. Yoon has some predictions on that as well. So we're going to talk a little bit about national days on market and maybe months of inventory. So when I show numbers there, for example, these blue right over here, the blue 10 for days on market down here, and orange 19 days on market. Those are all the existing sales, condo townhomes in the orange and single family in the blue. Green is single family new construction, and yellow or gold is condo townhome new construction. So Dr. Yoon combines those two together. So I've kind of done a little bit of a mashup there and done that as well to compare as we move forward here. So let's get started. Yes, it is probably one of the best meetings we have all year for the real estate economic outlook. The reason I say it's the best, and because I go to two of these at least every year. I go to the November meeting at the national convention, and then this is the mid-year meeting. And what I like about this meeting's timing is that it's just at the beginning or the early parts of the summer market in this particular case this year. And it kind of gives us an idea of a roadmap that we're going to head down versus the November meetings where we're kind of seeing what has happened, and then Dr. Yoon's making predictions for the entire next year. So as always, yes, don't worry, I did get my selfie with Dr. Yoon. I get those every single year, and he's always happy to oblige. So um, the audience at this event for this particular session is always full. In fact, it's standing room only by the time he gets started. You can see in the photo down there that I took as a panoramic. We had prime seating, and yes, that seat right there is the one that I sat in. So It was really, really good to be up close and pay close attention. The other thing you're going to notice here as well, at the bottom of every slide from this point forward here, you're going to see this URL. The slides I'm going to show you today came from Dr. Yoon's annual uh, presentation on the real estate and economic outlook. I've pulled many of them to include into this week's show and compare to Iowa, but there's many, many, many more that I did not. So this URL will be in the YouTube notes and in the also in the social media comments, so you'll be able to just click on that. But if you wanted to write it down, this will be displaying at the bottom of every screen throughout the show. So let's start off with what Dr. Yoon started the program off with. First of all, he started off talking about mortgage rates and the Federal Reserve and the effects of the 10-year Treasury rate based, and of course then the mortgage interest rates. What you see here is the chart he provided. The red line is mortgage rates and the green line is the 10-year Treasury. And essentially mortgage rates are basically calculated based on the 10-year Treasury. And what you can see is that we're above the 10-year Treasury line, which we typically are anyway. But the gaps between them, are usually is pretty good. And what you've seen here, especially if we look over here, January 2022, you can see that we were fairly close together of those two rate lines there. And then as rates began to climb, rates climbed up, even though that the mortgage, the 10-year Treasury hadn't climbed as much. So there's quite a really pretty good size spread between those two metrics there. And a lot of that has to do with economic pressures and things else that are going on. We're going to kind of talk about those this week or in this show as well. But just know that we have room for rates to come down, even if the 10-year Treasury does not maybe necessarily come down. But there's got to be some other factors in the marketplace that's going to do that for us. So to give you an idea of how this looks compared to the market mortgage rates charts that I show, and this is a good example of maybe why the market is slowing down just a little bit here. And what I did was I analyzed this graphic here. This is from 2020 through 2025, the mortgage rates, and it's got the division there of each year, so you can kind of see where we were during each year. And for the base point here, we're really looking at when we were under 4% of interest rates and then above 6%. And there's a little section there in the middle that you can see that's between 4 and 6%. And it was only about, maybe 6 months, probably about 5 months there that we went from 4% up to 6%. And then we've stayed at the higher points. And so just to give you an idea, the first 2 years in this graphic, from 2020 to 2021, that's when mortgage interest rates were averaging around 3%, 3.04% to be exact. And that's, so when we have home buyers out there claiming, they really wanted that 3% rate, this is the time frame that it was going for. It was not much before 2020. It was like middle of 2019 when we actually dropped below 4%. So really there was only, at best, maybe, 25, 28 months at the most of sub 4% interest rates. But buyers continue to think of those and remember those, thinking like it was that way forever. In between there, that's that point I was talking about. It was actually about 9.5 months to go up 3.7%. So from once it hit above 4%, all the way up until it hit over 6%. That was the spread, and it took 9.5 months for that period of time, which seemed to go very, very quickly, especially because it was right in the middle of our spring and summer markets there. So, the time passes quickly in that time period anyway, and then for everybody to feel like they were seeing mortgage rates really rise, that's a feeling that was well founded there, because in 9.5 months it went up, just under 4% in the matter of 9 months there. So at the very top, you can see then now, and this is to date, we have yet to be below 6% ever since it raised back up into that above 6% rate there in 2022. And so if we take the point forward from when we crossed over to 6% to date, the average rate across that timeline there is 6.75%. Now, yes, there were times it was above 7% and actually almost came to 8% at one point, but it never did get into 8% officially, and it has not got under 6% again. The fact that it did go above 7% and we're still at 6.75 for the average means that it wasn't in that upper rate number above 7% for very long there. We just basically touched it a little bit in 2022 and then spent probably about 2 months or so of it above 7% in 2023. For the rest of that time there, we've been under that 7% and hopefully moving backwards down to that 6.5%. So one of the questions we frequently are asked, and also that Dr. Yoon touched on at the convention, was when do we expect that the Federal Reserve will cut rates again? And it all has to do with the consumer price inflation rate. And currently we're sitting at 2.3% in April, and the goal is to get it under that 2% number. So we're very close. In fact, we spent much of 2023 at above 3% in the CPI rating. And so 2024, it was partially in there, half the year was under. In fact, it looked like as we were going into the fall that it was really going to keep going down. And a lot of the predictions that Dr. Yoon made were based on the consumer price inflation rate at that point, about 2.4, 2.5%. So we're really in a good position, I think, from his conversations with us that day, showing us that we're currently at 2.3%, and it's kind of heading downward. If we can get under 2%, then I think that's when we have the best chance of perhaps seeing a rate cut. So what does it take for the rate cuts to actually occur? Well, basically, it's anything that's happening in our marketplace that's inflationary going away and becoming disinflationary. And we'll talk about the two inflationary items here in just a second, but let's talk quickly about what is shelter cost. Shelter cost is the cost of housing as far as rental housing. Rental prices have come down in the last 12 months or so. It's not now quite as expensive to rent. Also, on top of that is income has gone up. So if there's a little bit more money out there to spend, and some of the rental costs have gone down, so it's making shelter cost more affordable. So that's not an inflationary key factor that we have to worry about. It's disinflationary. Deregulation. Of course, the Trump administration, that's one of his trademarks, is deregulating. He does not like regulation, so he's into deregulation, and that is always a good thing for the financial side of the country here. So we're seeing a lot of this, again, not an inflationary tactic there. Oil prices are down. You probably noticed gas prices are down what they have been, just above $3 a gallon, and that's a good sign. And that's helping us. The reciprocal tariffs to zero. Now, we're going to talk a minute about tariffs at the top up there, but the fact that the government and President Trump has gotten several of our tariffs either to equal out. In other words, if we're buying and selling equal amounts of materials across borders, and we have equal zero or equal tariffs, then the net effect of those tariffs is basically a zero reciprocal tariff. Or in some cases, we've actually even got the tariffs removed. So as far as reciprocal tariffs go, everything is looking good in that regard. So that is disinflationary. Our economy weakening a little bit. Again, we typically don't see inflation when the economy is weakening. It's typically when the economy is heating up too fast is when we see inflation. So when we see a weaker economy, that does not tend to lead to higher inflation. And then, of course, this is something fairly new as well. Pharmaceutical drugs. One of the things that the government is working on very, very hard this year with as far as getting the cost of prescription drugs down. And they're making great headway. And in fact, this is fairly recent news out there, so I would be starting to watch this information a little bit more if you're reading some of the national news out there, because this is really going to play a big factor, I think, is getting the cost of you know, drugs and prescriptions down. Now, the two areas that are still inflationary, and we'll start at the bottom one here, is dumping and weakening the dollar. Effectively, that's China out there dumping the US dollar back into the economy. And that has an inflationary effect, making the dollar just a little bit weaker. And that's China's way of flexing their muscle. It's not quite, I don't quite 100% understand that concept, but Dr. Yoon really had a good comment about that, and so that's really one of the factors that if you know, if our dollar becomes stronger, obviously we're going to be in less of a chance of having inflation. And then, of course, the top one up there, at the very top, is the tariffs. You know, President Trump is pretty heavy-handed with the tariff situations, and we still do have several countries that are basically charging us a larger tariff than you know, what we are charging them, and they're in works to get that to a reciprocal status, as it were, like I was talking about in the beginning, getting that tariff to zero or equalizing out. But right now, tariffs and the talk of tariffs is really causing probably the most problems with our economy right now, keeping that inflation rate up. But when you see all these areas of disinflationary activity, that's one of the reasons why our Fed rate is probably going to go down when the consumer price index comes down around that 2 or below, underneath that 2%. So that's about the heaviest part of the show. It's just some of the stuff I'm not as 100% comfortable explaining, but I think I've got it, at least at this point here. So Dr. Yoon provided a little bit more information about how the real estate market is coming along and how it's related to payroll jobs. And of course, everybody knows that we've increased jobs since COVID. In fact, we're 7 million jobs more, 7 million more people working since pre-COVID time period. And of course, the graph shows you right after the March or so of 2020 is when you know, we lost all those jobs temporarily, and it has steadily grown back. It took about a year and a half to get back, but we're now well above the pre-COVID numbers, and that's a good sign. And so when we put that into perspective, looking at job gains by state pre-COVID, so this is going back from pre-COVID to today. We're at the state of Iowa. You can see right there in the middle. We're at 1.2% of increase in jobs since pre-COVID. So ours went down and then we came back up, and we're just above, you know, almost 1.5, closing in on 1.5. The green states that are indicated there are the states that are seeing double-digit increases from pre-COVID. States like Texas, Florida, Georgia, South Carolina, of course, the Utah and Nevada and Idaho are all, you know, states that there's either a lot of, I don't know, recreational things going on there. There's a lot of entertainment industries or manufacturing in those states. And so to see double digits, that's something that's pretty cool. I wish we were a little bit higher. We're only at 1.2% from pre-COVID. And actually, the outlook doesn't quite look even as good when you look at it just year over year. So our job gains in the past 12 months, from April 2024 to April 2025, we are actually down just over 0.5%. And we're only a handful of, you know, 4 states that actually had a decrease in year over year gains. So this is another reason why perhaps Iowa is seeing a little bit slower market pace than maybe some of the other states. So this is just, again, something for us to watch year over year. If you look, there really isn't anybody out there really knocking it out of the park. There's still, you know, between 1 and there's a couple states, I think, I'm just trying to see them in there, like Idaho. It's got a 2.5% increase year over year. I think they were the leader. But it's, you know, still tough to see Iowa at just a little bit of a loss. So again, that's a lot to do possibly with why our market's slowing. As far as wage growth goes, Dr. Yoon was stating again that the red line on this graphic is wage growth, and the consumer price is the blue line here. So ever since probably early spring of 2023, the wage growth, in other words, increase in wages that an individual receives, has actually increased since over has not increased, but it's outpaced the consumer pricing. Even though the wage growth looks like it's slowing down just a little bit nationally, all the way back to January of 2022, we're still outpacing the consumer pricing. So what that means is that people have a little bit more money, and also the cost of goods are a little bit lower. So we're feeling a little bit happier going to the grocery store, as he put it. In fact, he made several jokes about the cost of eggs and how the fact that eggs are really not the issue. It's just basically what a lot of the people are talking about to try to make a point on the other end. So the cost of eggs are not really a factor like they were. As far as existing home sales, so now we're going to jump into actual home sales. He stated that 2023 and 2024 so far appear to be the 2 years that are going to be the most difficult years. And by difficulty means we're probably going to have the lowest number of closed sales by the end of the year in 2025. So 2023 and 2024, we're right around 4 million sales annually nationwide. And if we look at the sales that we had here in Iowa, and I'll just slide this over here to the right just a little bit so we can see how we compared, not necessarily in numbers, but at least in the, keeping the similar types of years together. You can see that 2023 and 2024 for Iowa, and in central Iowa here in particular, were very, very similar to what we saw nationally, just pretty well flat. And he expects to see that nationally, there's still a call. Well, I'm getting ahead of myself. I'll show you the predictions here in a minute, but there is a call that he says that we will be ahead of last year's closed sales by the end of this year nationally. Now, whether we are here in the Des Moines market, that's yet to be seen. As far as months of supply, it's easy for me to say. Months of supply, or supply of inventory is the way he puts it. The new homes are the red line, the existing homes are the blue, and this is the data that I told you early on when we were looking at the dashboard, that I had to combine the Des Moines markets existing homes together, because I separate them from existing homes, condo townhomes, and single family, and same thing for the new construction. And we're currently at 8.5 months nationally for new home sales, and 3.6 months nationally for existing home sales. And if you look down there at the bottom, Iowa and the central Iowa market here is a little bit faster pace. We've got a little faster pace, which is keeping our months of inventory at 2.7 months instead of 3.6 nationally, but we're spot on with new homes when you combine both condo townhomes and the single family new construction out there at 8.5 months. So that's a good sign to see that we're kind of on that same line there. I like it when we match up or outperform, especially the national numbers. As we get down here to the median pricing, same situation applies. The existing homes are combined, and the new homes are both combined, both categories. And first of all, notice down in Des Moines, we're about $293, $250 for the average list price of all homes listed, and new construction is around $351,900. Now, remember, this is combining the condo townhome new construction, which is the lower price, because new single family new homes is closer to that 400. So you can see what really is probably pulling that average down is the existing homes, or I'm sorry, the new construction condo townhomes. Now, what's really, really interesting is if you look right over here to the far right, and I'm going to click the mouse and show you and blow this up here. Remember, red is new and blue is existing. And nationally, we actually have a higher national median price of existing homes than we do for new construction. And that's really kind of an oddity. I mean, it has been happening a little bit here this year, but traditionally, if you look back here, existing homes are almost always lower price than new homes. So this tells me that new construction pricing is not continuing to rise like it has. It's not that they're coming down in price. It's just that the price of new construction homes for sale are not as high as they have been year over year. They're not seeing those same types of increases. Yet existing homes are continuing to rise. So this is going to bolster new construction a little bit. The fact that it may be considered more affordable now in our marketplace, I'd say probably still not. I mean, new homes are still more higher dollar purchase properties than our existing homes. So again, this is just a national number, and it's something we'll kind of watch here as the year goes through. As far as price home gain, so we're going to do the same exercise we did with um, job gains and things like that before with the national numbers with the states. We're going to look at 5-year home price gains. So this would take us pre-COVID, and what you see here right in the middle is Iowa's at 42.2%. In other words, if you owned a home prior to COVID, and basically you're seeing across the board, the state of Iowa is seeing a 42.2% increase in home values just based on the rise of values year over year. And that's a pretty substantial number. But again, we saw those prices really, really take off in 2022 and 2023, and they've kind of leveled off now the last couple of years. But 42.2%, that's really good. Now, not nearly as good as these states that are green. The winner over here is Maine at 75% increase since the 5-year period before COVID. That's just amazing. It's that high. But a lot of the states down in the southeast, down here from Tennessee and South Carolina, Georgia, and North Carolina, are all seeing plus 60% increases in values. And then you get back over here again to the West Coast states, predominantly New Mexico and Arizona and Utah. Not Nevada. Nevada is only about 52.9. But again, 75%, wow, that's just huge. Now, if we look at this same graphic or this same metric just on a year over year basis, recent 1-year home price gains, this is showing the state of Iowa at 3.8%. And that's probably pretty accurate. If you remember when I did our price appreciation numbers at the end of the year, I think I said that the Des Moines market, and in particular overall Des Moines market, was around that 5% or so increase in rate. And the 3.8 is going to take into account overall a lot of the rural communities where pricing is a little bit lower and the demand is not quite as high. So 3.8% is probably a very accurate number from the numbers I've seen. And you can see again, just a year over year, we have not seen a major large increase. Again, about the biggest ones we see are up here in the Northeast, Vermont and Maine and Massachusetts at 7.3. That's still a pretty good number there. So, I'm sorry, that's New York, 7.3. Anyway, the forecast, and we'll finalize this show right up here. Dr. Yoon basically updated his forecast for the remaining year of 2025, and then I'll show you the 2026 predictions as we go down the list here. So he says existing home sales, he predicts that they will end the year 6% up over last year. So if you remember we sold about 13,000 sales last year. 6% up from that would be quite a jump for us to achieve. So I don't really feel as though we're going to hit 6%. We might see a 1% increase year over year of existing home sales, but it's hard to say. As far as new home sales, again, I think I mentioned 13,000. That was total sales, both including new construction and resale. The new sales, new construction number here, he says, is going to be up by about 10%. And, I think we'll see that probably closer to flat for Iowa this year. For 2026, the existing home sales, he's predicting that the existing home sales will be much better than in 2025. And that's also why he says that the last 2 years were the worst years. We'll see a little bit of a gain this year. And the next year we'll see, in 2026, we'll see over a 10% is his prediction. As far as new home sales, he's expecting those to tail off just a little bit. And I think that probably has a lot to do with cost of materials and permitting and things like that. There's definitely going to be some challenges in the next year with economic trade wars or tariffs, whatever you want to call them. As far as the median pricing, he's seeing us go up about 3% this year, 2025, and I think it is going to be hard to hit over a repeat of our 5% increase of values year over year that we saw this year, because we're just right now a lot of our pricing is down. Listing prices are down a little bit, and subsequently our sale prices are coming down just a little bit too. Not dramatically. We're not falling off the edge or anything. But I think we're going to be somewhere between that 2 to 3% increase this year. And Dr. Yoon predicts in 2026 we'll be up about 4% nationally. So I don't have any numbers yet to be able to tell me where I think we'll be next year on that one. As far as mortgage rates go, he still believes that even though rates right now are at 6.86, I think he still believes that we're going to end up the year closer to that just under 6.5%. And I think that's probably something that can happen in our marketplace, but I think it's going to come after the summer market here. We aren't going to see those rates come down probably till maybe August, September, November type of the year. As far as 2026 prediction, he's thinking that they're going to settle just a little bit more down right around that 6%. But again, he's not calling for those rates to be under 6%. And that's going to be a hard one to, I think it'll be good for the marketplace. Again, as we talk about mortgage interest rates, as long as they're stable and don't go dramatically up or down, the market tends to still feel like there's some confidence there. If we get down to 6%, I've said this before, I think there's some magic things that will start to happen in our real estate market. As far as job gains go, he expects jobs to increase by 1.6 million this year, and under President Trump's leadership, he expects another successful year of new job creations at 2.4 million, as many companies get some credits and incentives to keep businesses in and relocate back to the United States. So there's an economic hopefulness there of that number there of 2.4. So all right, guys, that was a long show. I apologize. I try to keep these around 12 to 15 minutes at the most, and this one's 30 plus minutes this week, but I think it really had a lot of good information in it. Please share the channel with me, or for me every week. This helps get us more viewers and helps the channel grow and helps me continue to learn what you guys are liking to hear about. So thank you so much for joining us this week, and we will see you all again next week. Next week's show will likely not be out until probably Monday. I've got a commitment on Sunday now that I'm probably not going to have any time to put the show together on Sunday, and I don't want to do it ahead of time and miss out on the actual stats. So watch for this to come out sometime probably late Sunday afternoon or evening. Monday evening next week. Anyway, we'll talk to you soon. Have a great week.